Imagine waking up tomorrow to find that your savings are worthless, your loans are more expensive, and the entire economy is on shaky ground. This isn't just a bad dream. It's a reality that Jamie Dimon, the CEO of JP Morgan, America's biggest bank, is warning us about. Today we're diving deep into his dire prediction that could see interest rates skyrocket past 8%, a scenario that could turn the dream of economic stability into a nightmare. Jamie Dimon is the CEO of JP Morgan Chase, a financial giant with a market capitalization of over $500 billion, managing over $2 trillion in deposits. Recently, Dimon shocked investors and citizens alike by stating that the likelihood of a smooth, trouble-free economic future, often called a Goldilocks scenario, is far less probable than most people think. His insights come at a critical time. According to Bloomberg, the current U.S. government debt has ballooned to an unprecedented $34 trillion, up nearly 50% from $23 trillion just 4 years ago, pre-pandemic. This isn't just a big number, it's a towering inferno of fiscal irresponsibility that threatens to burn the pillars of our economic stability. Dimon's warning is clear. Without a significant shift in how we manage our economy, we're heading towards an economic meltdown that could rival the worst financial crisis in history. Today, we'll break down Jamie Dimon's warning, explore the data behind his predictions, and discuss what this means for you, your job, your mortgage, your savings, and your future. Jamie Dimon's economic warning. Do you know that soon getting a loan for your dream house or growing your small business might cost you a lot more? This isn't just speculation. Jamie Dimon, the big boss of JP Morgan, is warning us that interest rates could shoot up past 8%. Imagine paying double or even triple every month for the same loan. That's the future we might be looking at if things don't change. Right now, loans are cheaper, which makes it easier for people to buy houses and cars or for businesses to expand. But Jamie Dimon's recent message to his bank's shareholders was clear. These good times of lower interest might not last. An 8% interest rate could really shake things up. This means everything from buying a home to running a business could become a lot more expensive very quickly. The Wall Street Journal explains that if interest rates hit 8%, the monthly payments on new mortgages could double. For a family or a small business, this isn't just a bump in their financial road, it's a huge roadblock. Higher borrowing costs mean people would think twice about spending. This pullback in spending could hurt businesses, leading to fewer jobs and slower economic growth. Consumer spending is a huge part of what keeps our economy moving. It makes up about 68% of the U.S. economy, according to the latest data from the U.S. Department of Commerce. If people stop buying because loans are too expensive, the whole economy feels the pain. Shops sell less, factories make less, and businesses start cutting jobs. Jamie Dimon's warning is like a big, loud alarm bell. He's seeing danger ahead and telling us to get ready. He points to big debts, high prices that don't seem to go down, and decisions from leaders that might not fix these problems. All these factors could push interest rates up to levels we haven't seen in a very long time. The current economic indicators. Imagine a dashboard full of warning lights flashing red. That's pretty much the current state of our economy according to the latest data. With rising inflation, shaky job reports, and slow-growing GDP, the signs are clear. We might be heading towards some serious economic trouble. Let's break down these indicators one by one to see how they connect to what Jamie Dimon warned us about. Last month, the Consumer Price Index, CPI, which measures what you and I pay for everyday items, jumped by 8.5%. To put that in perspective, a grocery bill that was $200 last year now costs $217. For many families, that extra cost adds up quickly and cuts into money that could have gone to savings or other needs. Dimon's fear of persistent inflation isn't just a guess. It's happening right now, and it's eating into our wallets. While the unemployment rate looks good on paper at 3.8%, the real picture is more complicated. The U.S. Bureau of Labor Statistics shows that while more people are working, wages aren't keeping up with inflation. That means even though you have a job, you might not be doing as good as you think because your dollar doesn't go as far. It's like running harder and harder but staying in the same place. And finally, there's the GDP growth. Last quarter, the GDP grew by just 1.9%. While that's positive growth, it's like a car barely moving forward. Economists usually say that healthy growth should be around 2 to 3%, at least, to keep up with population growth and new demands. We're barely hitting the minimum, which signals that the economy isn't as strong as we'd hope. When you line up these indicators, high inflation, decent but not great job reports, and sluggish GDP growth, it's clear why Jamie Dimon is sounding the alarm. It's not just about high interest rates, it's about an economy that might be on the brink of a serious slowdown or even a recession. His warning is backed by real numbers, and these numbers tell us we should be preparing, not ignoring the risks. If you like this video so far, please take 2 seconds to help us out and hit the like and subscribe. Each like and subscribe helps support the channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. Government spending and fiscal policy. Think about a family wildly overspending their budget every month. That's a snapshot of our current government spending. With the national debt soaring to levels never seen before, it's clear we're on a dangerous path. Let's dive into the figures to understand just how deep this problem goes and why it's a ticking time bomb for our economy. Last year alone, the U.S. government spent a staggering $6.7 trillion, but here's the kicker. It only brought in $4.8 trillion in revenue. That means there was a deficit of nearly $2 trillion. It's like a family earning $48,000 a year, but spending $67,000. The math doesn't add up, and eventually, this kind of spending catches up to you. The impact on our national debt is jaw-dropping. According to the U.S. Treasury Department, our national debt has now surpassed $34 trillion. To put that into perspective, that's about $102,000 of debt for every man, woman, and child in the country. And this debt has been growing fast. Just a decade ago, it was around $16 trillion. We've more than doubled our debt in just 10 years, a rate of increase that is simply unsustainable. But what does all this mean for the average American? High government debt can lead to higher taxes in the future and cuts to essential services because the government has to pay more just to cover the interest on its debt. Last year, the government paid over $400 billion in interest alone. That's money that could have gone to schools, hospitals, or lowering taxes. This level of spending is not just irresponsible, it's downright dangerous. It threatens the financial stability of future generations and undermines our economic freedom. The government needs to start embracing fiscal responsibility, which entails spending within our financial capabilities and not passing on today's debts to our children. These aren't just numbers on a page. They're a warning sign that we need to change course before we find ourselves in an economic crisis that could have been avoided. Jamie Dimon's warnings about high interest rates ties directly into this scenario. Higher interest rates could make the government's debt even more expensive to service, potentially leading to an economic meltdown. Implications of high interest rates. Imagine flipping the switch on a machine that slows down everything around you. That's similar to what high interest rates can do to an economy. As Jamie Dimon warns, if interest rates hit 8%, the ripple effects across various sectors, real estate, banking, and everyday shopping, could be severe. Let's break down what this means in real numbers. Right now, the average mortgage rate is around 7.9%. If rates jump to 8.5%, the monthly payment on a $300,000 mortgage would increase by a couple $100. According to the National Association of Realtors, this kind of increase could reduce homebuyer affordability by 30%. This doesn't just mean fewer people can buy homes, it also means lower demand, which can lead to falling home prices and a potential crash in the real estate market. In the banking sector, high interest rates can lead to higher loan defaults. Banks lend out money expecting it to be paid back with interest. But if rates are too high, businesses and consumers may struggle to repay their loans. This could lead to an increase in non-performing loans. To put this into perspective, during the last financial crisis, the rate of non-performing loans rose to nearly 5%, significantly straining the bank's balance sheets. For consumer spending, the effects of high interest rates can be direct and immediate. Higher rates mean higher costs for borrowing money, which can lead to a decrease in big purchases like cars and appliances. The Federal Reserve has shown that in past instances when interest rates rose by just 1%, consumer spending growth slowed by up to 0.5%. This might seem small, but in a $21 trillion economy like the US, this translates to billions of dollars less circulating in the economy. Looking back historically, during the late 70s and early 80s, interest rates were as high as 20%. The economy struggled with stagflation, where inflation and unemployment rates were both high. It was a tough time for everyone, and it took years to recover. High interest rates were a big part of the problem then, and they could be again if we're not careful. These aren't just theoretical numbers, there are potential realities that could affect each and every one of us. High interest rates can slow down an economy quickly, making it harder for everyone to afford basic needs, let alone save for the future. Jamie Dimon's warning is not just about numbers, it's about our livelihoods, our homes, and our futures. Stagflation risk. Stagflation is when high inflation meets slow economic growth and high unemployment. It's like having the worst of both worlds. Prices on everyday items like groceries and gas shoot up, but at the same time, the economy isn't growing fast enough to create new jobs. This can lead to a painful squeeze on household budgets and overall economic stagnation. According to the U.S. Bureau of Economic Analysis, while the general price level, measured by the Consumer Price Index, has risen by over 6% in the past year, GDP growth has been tepid, barely nudging past 2% annually. This mismatch is a classic early warning sign of stagflation. Moreover, sectors such as manufacturing have seen almost no growth, which signals a slowdown in economic activity. The employment scenario adds to these worries. While the headline unemployment rate is relatively low at around 3.8%, the underemployment rate, which includes part-time workers who want full-time jobs and people who are too discouraged to look for work, is significantly higher. This paints a picture of an economy where many are struggling to find adequate work, which is another hallmark of stagflation. Inflation expectations compound the problem. A recent survey from the University of Michigan revealed that consumers expect inflation to remain elevated at around 5% over the next year. Persistent high inflation expectations can lead to higher wage demands, which businesses might meet by raising prices further, creating an inflationary spiral. This cycle is difficult to break without causing significant economic pain. Reviewing past periods of stagflation, such as the 70s, provides further insight. During that decade, average annual inflation was around 7%, while GDP growth slowed to below 3%, and unemployment rates hovered around 6%. The similar patterns we see today suggest we could be on a similar path unless significant policy changes are made. Stagflation isn't just a term from economic textbooks. It's a real risk that could affect jobs, savings, and the cost of living. The signs are there, and they're troubling. As Jamie Dimon has warned, ignoring these signs while hoping for the best could lead us into a situation where the economic challenges of the past become the crises of today. The role of the Federal Reserve. The Federal Reserve's job is crucial, steering the U.S. economy towards growth while keeping inflation under control. It has a toolbox it uses to manage the economy, mainly through setting interest rates and controlling the money supply. Recently, their main tool has been adjusting the federal funds rate, which influences everything from mortgage rates to the interest on savings accounts. In response to rising inflation, which recently hit a 40-year high of 9.1% according to the U.S. Bureau of Labor Statistics, the Fed has been raising rates in an attempt to cool down the economy. In fact, over the past year, the Federal Reserve has implemented several rate hikes, pushing the federal funds rate from near zero at the start of 2021 to over 2.5% by mid-2023. While this may sound prudent, these actions have a wide range of repercussions. For instance, higher interest rates make loans more expensive, which can slow down spending and investment. The Fed hopes this will reduce inflation by cooling off demand, but there's a catch. If done too aggressively, it can also tip the economy into a recession. This balancing act is tricky. According to a recent report from the Congressional Budget Office, the U.S. GDP growth is expected to slow down to just 0.3% this year, a stark drop from the 5.7% growth in 2021. This slowdown indicates that the Fed's rate hikes might be cooling the economy a bit too much. Moreover, these policies affect not only large businesses but also small ones and everyday Americans. For example, the average interest rate on credit card debt has shot up to around 18%, making it harder for families to manage their finances. There's significant criticism about how the Federal Reserve is handling the situation. Many argue that the Fed has been too slow to respond to inflation signs and now may be overcompensating by raising rates too quickly. There's a belief that more measured, incremental adjustments might have been more effective, preventing the shock to the economy we're now experiencing. The debate over the Federal Reserve's role in managing the economy is more than just academic. It affects everyone's wallet. As we navigate these uncertain economic waters, the question remains, is the Federal Reserve setting us on the right course, or are we heading into the economic doldrums? With the looming threat of stagflation and a potential recession on the horizon, the effectiveness of the Fed's policies is under more scrutiny than ever. Global economic factors. Imagine a world where the economies are so connected that a sneeze in one country can cause a cold across the globe. This is not just an imagination. It's the reality of our global economy. Today, we're looking at how international trends can impact the U.S. economy, focusing on trade relations and the growing trend of deglobalization. Global trade is a huge driver for economic growth, but it's also a source of vulnerability. The World Trade Organization now expects world merchandise trade volume growth of 0.8% in 2023, down from 1.7% in the latest forecast. This slowdown affects American businesses that export goods worldwide and can lead to job losses and lower economic growth here at home. For instance, U.S. exports to China, one of our largest trading partners, dropped by 10% last year, reflecting strained trade relations and tariffs that hurt both countries. Another aspect to consider is the stability of global markets. Recent fluctuations in major economies like China and the European Union have direct impacts on the U.S. For example, when China's real estate giant Evergrande was on the brink of collapse, it caused global stock markets to tumble, affecting U.S. retirement accounts and investments. The instability of such a large player in the global market can lead to widespread financial anxiety, affecting spending and investment decisions worldwide. The trend towards deglobalization is also critical to discuss. More countries are looking inward, focusing on domestic production and reducing reliance on international supply chains. This shift has significant implications for the U.S. economy. A report from the United Nations Conference on Trade and Development noted that global foreign direct investment fell by 20% in 2021, suggesting a move away from global economic integration. For the U.S., this could mean higher manufacturing costs and increased prices for consumers, as domestic production is often more expensive than imports. Additionally, the move towards deglobalization has spurred an increase in trade barriers. According to the Economic Policy Institute, these barriers have potentially cost the U.S. about 1.7 million jobs over the past 2 decades, mainly in manufacturing sectors. The protectionist measures might protect some jobs, but can also lead to higher costs and less choice for U.S. consumers. In the context of these global economic factors, it's clear that what happens beyond our borders can deeply influence the economic health of the United States. As we navigate these complex international waters, understanding these connections and preparing for their impacts is crucial. The current global economic climate shows us that no economy is an island, and in an interconnected world, the U.S. must strategically manage its trade policies and international relations to safeguard its economic future. Investment advice and strategies. Navigating these turbulent waters requires smart strategies and a good understanding of where to find safe harbors. Let's explore some practical advice and strategies for personal and corporate financial management during these uncertain times. First, consider the importance of diversification. It's like not putting all your eggs in one basket. A diversified portfolio can help shield your investments from market volatility. According to a recent study by Vanguard, investors who spread their investments across multiple asset classes like stocks, bonds, and real estate saw a 20% lower volatility rate compared to those who invested in single assets. Diversification doesn't guarantee against loss, but it can provide a more stable return in a fluctuating market. In times of economic uncertainty, safe investments often mean looking at assets that traditionally have lower risk. Treasury securities, for example, are backed by the U.S. government and are considered one of the safest investments. Currently, the yield on 10-year Treasury notes is around 2.5%, which provides a reliable return in an unpredictable economic climate. For those managing corporate finances, liquidity is crucial. This means having enough liquid assets or cash to cover short-term obligations. The Federal Reserve reports that companies with strong liquidity ratios can weather economic downturns better because they have the cash to handle sudden drops in revenue or increased expenses without needing to take on expensive debt. Investing in technology can also be a strategic move during uncertain times. Companies that invested in automation and digital transformation have reported a 30% increase in efficiency, according to a recent survey by McKinsey & Company. This kind of investment can reduce costs and improve productivity, making businesses more resilient in tough economic environments. Finally, it's important to stay informed and agile. Economic conditions can change quickly, and the best investors are those who stay informed about market trends and adjust their strategies accordingly. Regularly reviewing and adjusting your investment portfolio can help you manage risks and seize new opportunities as they arise. While the economic outlook may seem daunting, with the right strategies you can protect and potentially grow your investments. From diversifying your portfolio to investing in safe assets and maintaining liquidity, these strategies offer a blueprint for navigating economic uncertainty. Remember, the goal is not just to survive the storm, but to emerge stronger on the other side. Check out this video next for more details on that if you liked this video.